unless specifically indicated otherwise, the content expressed are my views only and not necessarily those of LifePro Asset Management, LLC. The content presented is in no way an investment advice, solicitation, or an offer to sell securities or investment advisory services. The material is provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. I cannot assure the accuracy or completeness of these materials. As such, the information in these materials may change at any time without notice. Reference to these discussions about IULs and annuities or fixed insurance products. Investments on fixed insurance products are different from investments in the stock market. Any guarantees provided by a fixed insurance product cannot be assumed to be guaranteed for any other investment.
Welcome to the Rock My Finances show on K4HD Radio and Talk4 TV, where we put the fun in finance. Join Powerhouse Jennifer Joseph, CDFA, CMC, and Private Wealth Advisor, as she collaborates with you to create clarity, control, and confidence with your money, your way. It's not about the zeros, so what is it all about? Let's find out. Now here's your host and weekly friend, Jennifer Joseph.
Hey there. Glad you're back with me. Rock My Finances. Can you actually say that this week? Are you rocking your finances? We have a very special treat today. I can tell you, I've been in the industry for a very long time and I've moved around many times and I have landed in such an amazing place. And so I have been introduced to such smart people and we have one with us today. Being able to help people with their money and finances and financial plans, that's amazing. And I was with Edward Jones years ago and we did, I did the actual investment type stuff. Can't go into too much detail because of wonderful compliance, but you get my drift. And being able to have someone else that's way smarter than myself that knows what's going on, and then I can be my person with my clients and help them plan. That is my expertise. That is my strength. I look at their whole life. I look at money in every realm in their life, today, the past, and the future, and their legacy with their children's future. And we solve the puzzle. So being able to have someone else with you on this amazing team that can actually know about the investing part is such a godsend to me. Like, I'm so happy about it. And it's so great. So without further ado, y'all, I want to invite you to stay the entire time. We're going to have tips and tricks at the end, as always. And we're going to get such knowledge from Mr. Robert Rayburn. He is an asset manager here at LifePro Asset Management. He heads up the entire department. He's been doing this for many years. And we are going to share with you how you can learn more from Robert as well. So, hey, welcome, Rob.
Hey, Jennifer, how are you this morning?
I'm doing really, really well. Thank you so much for joining me on this busy day. I really appreciate it.
Hey, not a problem. Glad to be here.
Would you prefer Robert or Rob?
Rob's fine.
Okay, good. You've been Rob with me for the last several years. So I just want to make sure we're on our podcast now. Okay, awesome. So I want to talk a little bit about your career. And I always ask all of my guests the same thing. So I know you are a numbers guy and this is your head, but as you know, I'm also the certified money coach and I deal with emotions around money as well. So I'm going to ask you, what was the best thing that you spent money on in the last week that brought you joy?
That's a very interesting question. If you ask my wife, spending money never brings me joy. I will say spending money on my daughter's birthday party definitely is one of those things. It's just seeing the smile on her face. It's brings sort of that unlimited joy. She's turning 2 on November 8th, but we decided that we're going to have her birthday party at the pumpkin patch, which you can only do up until October 31st. So we did a little bit of a premature birthday party this weekend. So that was definitely money well spent.
That is so great. I love that. And it's such a unique answer as well. And I would have never thought of that. And I bet you had a total blast. I love the pumpkin patch.
Yeah, it's great. And she had a blast, and we had a bunch of little kids there, and it was basically just for little kids, not your typical, sometimes when you do a birthday party for 1 or 2 year olds, it's more about the parents and having, booze and stuff there, but
Yeah.
there was none of that. It was strictly there for kids and rides and stuff like that. So it was really fun.
That's really cool. That's really cool. And so what I'm working with my clients, I actually have them go a little bit deeper with that. Like you said, that is an unlimited joy. Like that is such a gift, right? And so I have my clients take that feeling and go deeper with it and remember that feeling when we don't want to spend money or when, bad things come up. We always want to remember that amazing feeling right there. So thank you so much for sharing that with me. I really appreciate it.
Hey, my pleasure.
So how did you get into this wonderful industry of finance? And if you want to tell your title now, feel free to explain where you're at now, and then share with us how you even got into this crazy business.
Sure. I think everyone sort of finds their unique way onto Wall Street, but for me, I kind of, as a lot of people, I think kind of had an uncommon path to this point. First, my title is head of wealth management here at LifePro Asset Management. So my job is to manage 4 specific tactical strategies across sort of the realm of risk tolerances for advisor clients. We don't sell our strategies directly to clients. We go through advisors and coaches such as Jennifer. And the reason for that is we don't have the bandwidth to really sort of serve at the behavioral level that a lot of our well-trained advisors do, such as Jennifer. So we specifically focus on the building, the construction, and the trading of our macro portfolios across those 4 segments. My career started in Toronto, Ontario, Canada, back in 2005. So after college, and even before that, I've always been into stocks and trading and things like that. It's just always kind of been a natural extension of my interests, and something that I passively enjoyed. Didn't do intensely during college. You're kind of busy doing, living life in college, obviously. But it was just something, for me, like the 9 to 5, the predictable same thing every day was never something that I could really stomach. And I think if there's definitely one thing about trading and portfolio management and just asset management in general, is that every day is a little bit different. And certainly the last 2 years have proven that, whether it's through COVID and the pandemic, the extreme inflation that we've seen over the last year, bull market, the bear market, the volatility, all of that stuff, while also nerve-wracking, definitely interesting, and gives yourself a new challenge every single day, and gives you that room to grow mentally and sort of expand your horizons out. So I started in Toronto 2005, working for a firm called AGF Management. Did risk management, portfolio attribution analysis, and then quickly sort of discovered while that was a great foot in the door, I wanted to be more actively involved in the actual portfolio construction process component of it. So I was able to secure a job at a hedge fund called Barometer Capital. Worked there for quite a while, up until 2012, 2013 time period, and then moved over to another hedge fund where I took on a portfolio manager role called Otterwood, and really worked there until I came to LifePro, and that was in 2016. So in 2016, had that unique opportunity, met with the founder of mutual contact that knew Bill and myself, and at the time I was looking for distribution opportunities. So as a hedge fund manager, returns are one challenge, but then the other challenge is how do you grow your asset base out? How do you grow your business out? And LifePro had a very strong distribution channel through great advisors such as yourself, Jennifer, and that's really where we saw a big business opportunity to marry up sort of a lot of the more income and tax protection strategies that life insurance and annuities offer, together with the investment piece. And that's really where the LifePro story started. So we kind of started from scratch, no assets under management. 2017, we launched the strategies, and today sitting over 300 million in AUM. So it's been a great journey, and definitely been through a lot of environments, from the 2008 crisis, the European debt crisis, China growth scare, COVID, the current environment of super high inflation and high interest rates. So our generation has come up through the ring of risk management fire versus the prior generation, which I would say had it relatively easy from 1980 to 2000.
Yeah, for sure. Totally agree with you on that one. Totally agree with you on that one. The most I lost in the very early years was like 50 grand in 2002 with the tech burst. And that was it. It was like, okay, it's way different now. So a couple things I just want to reiterate for people that maybe might be new at all this: bull and bear market. Just so y'all know, bull market's when the market's going up, and a bear market is when the market's going down. I know we use these words all the time and we never know sometimes what exactly they are. And then when Rob mentioned that he's over 300 million in AUM, that is called assets under management. So that means that he is managing portfolios with over $300 million. And that's exciting. It's actually on the range of that'd be like a middle boutique firm, right? Like because you're not beginning, but you're more of a middle boutique. Yeah, that's great.
For sure.
Awesome. Okay, so just clarifying some of those words there. I love it. And I love that you are doing what you love, and we can see it. So I meet with Rob every month with my clients on Zoom. So anyone who's in any of Rob's strategies, we invite to a call so that we know why he's doing what he's doing. And this is, I can tell y'all, this is unheard of. Like, it's just so wonderful to be able to speak with the actual person who's doing the trading in your fund. And it's just been so transformational for us as well. So I appreciate you doing that as well, educating us all along the way. And then one other thing you said was this, let's see, what'd you say? High inflation and high interest rate. And I bought my house at 12% interest. So this is not extremely high interest rate. Yes, it's higher than it's been, and it went up a little bit quick. However, what do you think? Do you think it's going to go up or down?
Tough to say. I think that, if you look at history right now, and we do the numbers, 85% of history, the 10-year interest rate has traded above the inflation rate, and the inflation rate's at 8% right now. So you can kind of do the math where the 10-year interest rate's sitting at 4. So, I think there's a lot of people out there saying, oh, the 10-year has gone up so much, it's overextended, it must have to come back down. One thing I've learned with markets don't have to do anything that you either want it to do or don't want it to do. And, throughout history, the way the Federal Reserve typically gets a handle on inflation is to get those policy rates above the rate of inflation. And we're still far from that point. And I think that's underappreciated in the market right now. I would add, I think one difference between, when, people in the 80s were buying houses at those high interest rates is the price of the house itself.
Yeah, it was only like 56,000. Yeah, you're right.
Yeah. So I think that the unique challenge for younger, call it the first-time home buyer, anywhere from 25 to 40-year-olds or 45-year-olds, is that you're combining a higher interest rate with a home price that really hasn't corrected all that much off record levels from just 6 months ago. And the combination of the two is taking home affordability at its lowest level ever. And I think that's the real stress point for your average family in the US, especially in high price environments. Like, we're in San Diego, so it doesn't take a lot of imagination to see sort of where those mortgage payments have gone for home buyers over the last, just in the last 12 months.
Yeah, agreed. And I'm from the Bay Area, same thing, right?
Same
a
thing.
lot of
Absolutely.
pockets there are outrageous as well. So going back to LifePro Asset Management and the way that you structure your funds, portfolios, and I believe like you say on your website, it's the modern investing for the 21st century. I love the modern investing. I mean, I feel that I do financial planning for the modern way because I do goal-based planning, time-based planning, which is why when I spoke with you a couple years ago and you said the same thing, I was like, oh my gosh, you're speaking my language, because
Yeah.
I've been in it for so long and I've seen so much happen that it's not about allocation. It's not about, of course, it is about allocation and diversification, but that's not the be all end all. I have to know when you're going to use this money. I need to know what time frame it's allocated for, and possibly what is it allocated for. Now, we all know life changes, financial plans change, all that stuff changes. However, I need to know where we're thinking it's going to be. And so when you said that about your funds as well, I loved that. I loved that time-based, goal-based planning. So tell me a little bit more about why you would be different than maybe a traditional money manager like I grew up with in Edward Jones, right? I know it's
Sure.
completely different, but go ahead and give me your 2 cents on that.
Yeah, so I think that most mutual funds out there are sort of buy and hold until you die type of mentality, and really at the end of the day, they want those assets to stay in as long as possible to pay as much lifetime fees as possible. But I think in particular, the way that the entire industry is set up is that everyone is sort of treated the same based on their age. And a 40-year-old versus a 60-year-old is going to get the same asset allocation recommendation from your Wells Fargo advisor. You go into the branch, they punch in your age and your income and all that kind of stuff, and they're all going to get sort of the same asset allocation recommendations. And it's so age driven. And for us, we don't discriminate based on age. We discriminate. When we say discriminate, I mean the recommendations that we coach our advisors to give is really based on what is the client trying to do, and what are the timelines around that goal, and what are the required rates of return to get to that goal, right? Because sometimes, as you know, there's clients out there that have goals and we're like, listen, I don't think that's realistic unless you take an undue amount of risk. But in 99% of the cases, the goals are realistic and there's timelines around them and there's required rates of return to achieve that. And that's way different than just saying, hey, you're 65, time to scale down your risk, or hey, you're 40, time to take a ton of risk. Like my wife and I just bought a house, right? So 6 months ago, you're probably not going in and buying a bunch of small cap stocks if we need that money to buy the house in the next 6 months. So I think that is something that distinguishes us, right? So a 40-year-old may have, due to what they need the money for in the next 12 to 24 months, may very well have the same risk tolerance as an 80-year-old if they both need the money within the same time period, right? And so, yes, we live in sort of this world where we want to hyper scale everything and simplify everything, but it's so important that for clients that are going to use our investment strategies, that they use them correctly, because we want those assets as a business, as a friend to our clients, as business partners to our clients. We want those assets to stay in for a very long time. And so I kind of compare our different strategies to different tools in your toolbox. And if you're looking to tighten a knob in the door, you're not going to use a hammer. It doesn't make sense. And so it's so important for us to make sure that our strategies are not just attracting business, but that they're being used the right way and for the right types of goals and objectives.
For sure. We want our people happy. We want our clients happy.
Of course.
It's another question I want to just bring up as well. As a financial advisor myself, I'm the link with the client, right? So I know my clients' dreams and desires and goals and family and legacies. I get to know my clients very well. And so I feel part of the family. I've become very good friends with my clients, and it's just a natural way, I think, at least as women, as a mom, who I am, I'm definitely a great relationship with most of my clients for sure. And it's a lot of pressure. It's a lot of stress. Like when my clients are upset, I am upset. Like I am upset. So I do, like, it's so funny. Like I don't watch the news. I don't bring any undue negativity into my world that I need to, because I have to be very aligned with where I am at, and being able to be there for my clients and of course, my friends and family. So for me, I have to stay upbeat, positive, healthy. Like my stress level, everything has to be good so that I can help them make very good decisions. And so for you to be on my team is very helpful, because I don't need to know what you know. I just know that you know what you know. And so that really helps me be able to be who I am with my clients and be able to help them make decisions. So how do you take the stress? Because you are front line. It's like you are front line with people's future, with their money, with the market. And oh, by the way, you don't have your crystal ball and you can't control squat. So all you can do is know what you know and take it further. But how do you handle your stress and this high performing job that you have?
Yeah, it's a great question. You mentioned something at the beginning of the show that I don't think can be understated, which is the behavioral aspect to investing. I think we always focus on the numbers, but if you actually look into realized performance for client accounts, the vast majority of clients that underperform over a long period of time, they own the right stuff. They were in the market. Let's just focus on index products, right? Like they were in the S&P 500 or whatever it was, but for some reason they've underperformed the S&P 500 by 40, 50% over a long period of time, or whatever the number is, right? And a lot of it is they get scared, right? They watch the news, they watch the media, and they sell on lows and they buy on highs, right? They got that FOMO, that fear of missing out when things are going well. And then the markets sell off for a month and they're out. And they continuously have this pattern. And the truth is that the stock market is the #1 wealth creator in human history. It beats real estate, it beats bonds, it beats everything. But it's also the hardest horse to stay on, because as that horse is galloping, right, you're hitting a lot of bumps along the road. And a lot of clients just don't like the ride, right? They don't like being reminded of how their net worth is changing day to day based on the ebbs and flows of the stock market. And that's the challenge that all of this creates. Real estate, we actually tend to see much more positive realized outcomes, because guess what is not updated every single day on your account? Your house price, right? You don't log into Schwab and, oh my house is down 2.5% today. Oh my God, right? You just kind of see, hey, I have this asset. I know kind of over time it's going to go up, and you don't have this constant reminder of you're wealthier or less wealthy like you do with your stock portfolio. And I think and of course you can live inside of a house. It has physical utility. So that's the real challenge of the stock market. Like, over the last 2 months, we've been pretty defensive. We've actually been short stocks, but over the last week, we've had this big rally. So all of our clients that were super pessimistic over the last 2 months and enjoying the fact that their accounts were up, suddenly we're like, oh my God, am I going to miss out the rally? Calm down. The market's gone up for 6 days, right?
Yeah.
That doesn't suddenly mean we're in a new raging bull market. What it means is we probably got a little bit oversold, right? Markets go up and they go down. In bull markets, sometimes stocks correct down. And what do? You buy into that. In bear markets, it's the opposite. Sometimes they go up. And what do? Well, you sell the rip, right? You sell those rallies.
The rip would be the high, right?
Exactly. So, we've all sort of heard that phrase, or perhaps we've all heard that phrase, buy the dip. Every single time the market comes down, put more money to work. That works in long-term bull markets, right? Where you have a strong trending upward bull market like we did from 2009 to 2021. those rules apply and they work most of the time. But when you're in a bear market and you're a downward trending market, you want to use the rallies to offload some risk so that ultimately when the market has a more durable turn, that we can actually buy some good merchandise at deeply discounted prices. Because at some point that turn will happen. We right now, it looks like we're in a bit long. The current bear market is going to be more reflective of 2000 to 2003 than say something like 2020, which lasted only a month. So it's just so important that we have discipline and not get super jazzed up by 3 or 4 days in the market, whether it's up or down, and try to change our entire plan based on that, because there's going to be a lot of people that chase this current rally and get burned, right? And it'll be those same people that are being like, well, why did you buy me stocks? Well, I didn't buy you stocks. You wanted to buy stocks, right? So right now, this is a moment for discipline. And also, it's so important for clients to have a coach such as Jennifer, because that's the behavioral aspect of investing, right? Coaching through these ebbs and flows. What is noise? What is substance? And do we have to make any moves as a result of that?
And then I bring it back to a plan. I cannot help you if I don't know where you're going. So we have to have a plan. You're going to have a plan either way. You have one now. Even if you're not planning on it, you have one. So that's where I come in to find out, okay, so like I just had a client that, is nervous right now. And so we went over the plan. And the plan is they are very healthy and probably going to live longer than they anticipated. So maybe we need to restructure some things. So it's okay to restructure things. It's okay to not outlive your money. Like that's our whole goal, right?
Yeah.
And so we want to put into place other streams of income in other ways instead of just one thing. So now let me ask you, Rob, this is good. When I hear I'm never going to do the stock market, it's purely a gamble. It's like going to the craps table and throwing it all on black or red. What would you say to someone that, 2 questions, someone that absolutely hates the stock market, is just afraid of it, doesn't know it, and doesn't trust anyone. And then the second one is someone who likes it, but understands that it's purely gambling. What would you say to those 2 people?
Well, it's not gambling. I mean, it's gambling if you make it gambling, right? If you got, I guess the best way I can say this is like, consider the stock market this campus, right? And you can go to different buildings, and one of the buildings is a casino. Well, yeah, if you go to the casino, it's gambling. But if you go to that other area of the campus, that it could be a business that you're trying to build and you're trying to invest in and participate in and sell more widgets, right? Then it's not. It's true investing. Stocks are going to change day to day, right? And the best way I kind of compare it to, you're going to go to a party and everyone's going to have an opinion of what everyone's wearing at that party. And those opinions will change based on the person, right? Everyone's going to have a different opinion as to what someone's wearing at that costume party or whatever you want to call it. I don't know if that's the best analogy in the world.
No, that's good. That's good.
Everyone has an opinion. And so over a very short period of time, so the stock market's slightly down today. What does that mean? Does that mean the world was that much worse today than it was on Friday? No, it just means very short term. People, for whatever reason, have a vote that they want to sell stocks lower. Now, if you're going to try time all these different opinions, then that's gambling. That's gambling.
Oh, that was a good point.
But if you say, hey, you know what? Like, I noticed this business, the stock of this business is down 20%, but they're making more money. Their margins are expanding. They're capturing market share. They have an extremely effective leadership in place at the company level, has a history of creating value. And that's not gambling, that's investing. It's all about your time periods and what you're trying to do. The stock market can appear as gambling because it is ultimately, like, the way the market is set up plays to the weakness of our human emotions. Humans are mentally set up to survive, right? We structure
Yep.
our society to live together, to share resources, to scale, all these types of things. But when it comes to investing, herd mentality is really bad, because when you do what everyone else is doing, you tend to be the last investor in. Where you can make a lot of money is saying, hey, I'm buying this business that I think is super cheap, but then being able to put up with the fact that 90% of the people out there are going to call you an idiot for owning that business, and you may stomach some losses initially to get that upside. So that's really the difference. It's understanding the difference. If you're trading stocks, you're trading paper. But if you're buying businesses like Warren Buffett does, then you're investing. The time period is what makes the difference.
That's awesome. On all my clients on our monthly call that we are buying businesses. We're not in a lumped fund with 1,000 different companies and just basically throwing a dart and hoping to pray. But that's not what we're doing. You are actually buying individual businesses in one of your funds. That's the one that we mostly talk about. And how is that business today is the most important thing. Like, would you purchase it today? So I love how you coach us on that. But you sidestepped my question, my dear. How do you handle your stress? You've got to have stress.
Yeah, there's definitely stress.
How do you handle it? Do you even handle it?
Yeah, you know what? Just a lot of drinking. No, I'm just kidding. No,
well, I can relate to that.
Yeah, no, listen, I think that as it relates to the stress, you just have to do your job. You have a process, and you try to improve that process every single day. You're never going to please every single client that are in your strategy, because I mean, if you're a fast growing business, you're getting new accounts every single day. So right. each of those clients are going to have a different return experience as to when they came in. And we all know, like, strategies, stocks, markets, they don't go up in a straight line. So, some clients may very well get in just at a short-term high water mark before dipping and then going back up. Or you may have clients very well that, listen, they've only worked with us over the last 6 to 8 months, and this last 6 to 8 months haven't been pretty in the market. So, what you ultimately do is say, listen, making sure that clients are appropriately using the strategies based on their timelines. And if they are, and they have time on their side, then the short term shouldn't matter too much. Now, is that going to get rid of all the stress? Of course not. There's always going to be an element where you second guess yourself. And honestly, if I look back at the mistakes that I've made throughout my career when it comes to trading, when it comes to investing, almost 95% of the mistakes that I have made have come from second guessing, have come from hearing clients or advisors complain about over the last 2 or 3 months of this or that, and then changing as a result of that, letting the noise impact me. And so as you grow as a portfolio manager, you learn to shield more and more of that and just say, hey, you know what? I'm going to focus on what the process is telling me to do. It may not play out today or tomorrow, but it's going likely, we think, play out over the next 6 to 12 months. Like, I'll give you an example. Like, we were all in on energy last year, and it took so long for that trade to play out, and we caved on it. Like, we actually sold a lot of the energy at the end of last year, and it was the wrong mistake. It was the wrong decision. And so you just learn, you just get to have patience. Over the long period of time, the market's a weighing machine. It weighs good value between value destruction. And if you just have discipline around that, you'll make money.
Yep. I love that. And that's why I like the other side of the house too, with the guaranteed income streams and the safer side as well. So if we all have a little bit of everything, we're going to be totally fine. So I love that. And you're right. When you do your job and you stick with your process, when I get off my process is when I become stressed. So you're absolutely right. Stick with your process. Know you're doing the right thing, and nothing's going to be foolproof. And all we can do is always update our plan. Always meet with your clients, update the plan, see what's happening, because we can always change of whatever we're doing. That's awesome. Okay, great. So we're going to take a little bit of a break and have an amazing commercial. And I'm so excited because I'm giving everybody a break right now. So Juan's going to cue up our wonderful commercial for Rock My Finances. We'll be right back. And then I have 3 tips at the end of the hour. So don't go away.
Wait, the show isn't over yet. There's more fun and finances ahead. Jennifer will be right back as we have a special bonus offer for you right here on Rock My Finances, broadcasting live on K4HD Radio and Talk 4 TV.
Hey y'all, it's Jennifer Jost. Are you ready to transform your relationship with money? Rock My Finances Club is your weekly mastermind for wealth empowerment. Join me live for your personal weekly group video sessions and access your personal portal with the video library at any time, including your success system and way more bonuses. Go to rockmf.com for your financial empowerment. Make yourself a priority today. Schedule a chat with me at rockmf.com and achieve your feminine financial freedom finally. Oh, and don't forget to ask me how to save 50%. See you at our weekly mastermind.
Okay, Rock My Finances on K4HD and Talk 4 TV is back. Once again, let's put the fun in finance with your host and weekly friend, Jennifer Jost.
That was great. And we're back. I'm so excited. I have a couple more good questions for you, Rob.
Okay.
There's a lot of do-it-yourselfers out there
Mm-hmm.
when it comes to investing. I know with the robo advisor, and I think there seems to be more now with more than from when I started. And that's great. And that's totally fine. And my whole thing is if it brings you joy, do it. I'm all about joy. I'm all about feeling really good and aligned with yourself. And if you enjoy it, that's great. I know a lot of my clients follow you and do their own fund is what we call it. And so they do their own trading, and that's great if you like to do that. So for someone who does enjoy that, and is there like 3 or 4 or a couple things that you always ask yourself before you purchase a stock?
Yeah. So one, I think you always have to define, is it a trade or is it an investment, right? There's nothing wrong with trading, by the way. You can make a lot of money doing it, but define, hey, I'm going into this security because I think, company reported numbers, Amazon opened down 20%. I think that's overdoing this stock, but if that loss shrinks to being down 10, I'm going to be out of it, right? So define, is it a trade or investment? What we often see are people that go into a trade and that trade becomes an investment because it goes the other way on them. If it's a trade, sort of have your band set up, and if it goes against you, get out. Eat the loss. There's nothing wrong with that. It keeps you in the game. If it's an investment, also have that discipline. Say, hey, I think this business is super cheap. I have like this 5-year timeline where I think between now and the end of 5 years, company ABC is going to create a ton of value. Here are the reasons why. And then sticking with that and saying, hey, are those reasons playing out? If they are playing out, stick with your investment, even if the stock goes down, right? Or maybe buy a little bit more. If those reasons are not playing out, hey, I really like the management team. Oh, the management team left or is recycled through. Or, hey, I think that they're going to capture X amount of market share, but the market share declined. All of those things are reasons like, oh, hey, maybe my thesis is not playing out. I need to revisit the idea. So whether it's a trade or whether it's an investment, I think it's super important to make sure that you're holding your reasons accountable and be willing to take a loss if it goes against you, because it keeps you in the game and rotates you into another idea. So that would be the way I would look at the world.
I like that. And you mentioned loss, which I love at the end of the year for any non-qualified accounts, meaning if it's not a retirement account and you are playing in the stock market, now's the time to harvest maybe any changes. You might want to look at your portfolio, because if you do have a loss and you do have a gain and you really wanted to get rid of that company, then you can do that now without a huge taxable gain. So talk to your advisors about that towards the end of the year. So I like to start doing that coming up. There's another great question. Do you trade if somebody is doing their own retirement account, say IRA account, Roth IRA account? or just their individual account that they're playing with, do you trade differently depending on what type of account it is?
I think it depends on what you're using that account for. Like some people, they have IRA accounts. Like we deal with some super high net worth people, and the reality is their IRA account is just a super small percentage of their overall net worth. So, they have the capacity to take a little bit more risk, versus like if you are relying on that IRA for your daily lifestyle, then I would say no, you probably don't have that capacity. Ultimately, it's your account, your money. You can do what you want with it, but I would say it all depends on what's the function that that account is supposed to serve. If it's
That's
supposed to
perfect.
serve, yeah, if it's supposed to serve your lifestyle, then be a little bit more conservative with it. If it's sort of play money, play with it.
What is the function for that account before you make the decisions? That's great. I love that. And that goes right into my goal-based planning. Like each account is going to serve a purpose. And so we look at the goal, we look at the time frame before we actually do the investing and make changes. And it's okay to make changes for sure.
And do what's right for you. Don't do what's right for your neighbor or your friend or your parents or your kids or whoever it is, because that's another, I think, mistake that a lot of people make. Oh, my friend just bought a Tesla because he bought this stock, and so I'm going to do the same thing. Well, your friend bought that stock at a much lower price and you're buying it off him at a much higher price, him or her. So do what's right for you.
Yeah.
Ignore others, because when you try to copycat other people, that's usually when you start to lose money.
I totally agree. And I love this. I had a woman come to me one time and she say, I want my portfolio just like my neighbor's because she just lives off the interest. And I said, okay, great. Let's take a look at everything. Okay. Well, her friend was getting, $150,000 in interest and dividend checks. And I'm like, okay, you don't have those assets to be giving you that. Like you can't do
Yeah.
what your neighbor's portfolio is. So it's, I know a lot of people talk and even at work and corporations, I'll have people come in and say, oh, one of my guys, that sits down for me is an amazing trader and he makes so much money and he's doing really well. And it's like, well, is he really he's working at a desk down from you. He's not retired. He's not multimillionaire. Like where exactly is he in the training cycle? And how do you know that for sure? Just because someone is saying that they're doing well, maybe on one thing, but maybe there's 5 others that he had to sell at a loss. We don't know that, which is okay. But are you getting the true gist of everything before you start following somebody else's advice? So I think, of course, being a financial advisor, everybody needs a coach. Everyone needs an advisor to look at their whole plan, their whole life before you make decisions on where things should go. And I know most people out there have their retirement accounts, their 401ks, that they have it in the time-based fund or the retirement in 2065 fund. Do you have any opinions? I don't know if you can say that compliance-wise. Is that something you can share information on?
On what specifically?
On those time, what are they called? The retirement, like if I'm going to
Time-based.
retire in 2065. Yeah.
I think personally, I think that the time, those time targeted funds are a little bit of a marketing gimmick, because what they essentially do is they put you more and more into bonds as you get closer and closer to so-called retirement. What they don't account for, of course, is your timeline, and they don't account for your goals and what you're trying to do and what the specific asset allocation might be appropriate for your specific objective. The other problem, of course, is you assume that bonds are always low risk. Look at this year. Bonds are down 20%, right, in some cases. And that's not low risk. If you're sitting in a so-called bond fund, you're like, okay, I'm going to start using this next year, and it's down 20%. I don't think anyone's looking at that result saying, hey, this is low risk, nice glide path off to retirement. So a lot of these funds and a lot of these different strategies have been developed over the last 20 years in a long-term bond bull market, right? In an environment where interest rates over a long period of time have been tending to decline. That's not always been the case in history, right? So bonds The bond cycle, interest rate cycles tend to move in these 30-year cycle periods. And from 1950 to 1980, long-term interest rates actually went up. And so those types of models did not necessarily work. It didn't make necessarily sense as you approach retirement to continue piling into bonds. But those weren't questions that people had to answer back then, because most people had defined benefit plans, or otherwise known as pensions. And so I think it's just really important to, really troubleshoot what you're trying to do, and does it actually make sense in the current environment. If you think interest rates are going up from here, it may not make sense to go and sell your stocks and buy bonds. Now, it may make sense to sell the stocks, but doesn't mean you go and buy the bonds, right? And these time-based asset, or not time, these target date funds.
Yes.
Yeah, the target date funds, I don't think do a very effective job at that.
Yeah, I agree. So anybody has a target date fund, give me a holla and we'll have a chat. So next question for you. Tell me about, let me see. Someone who might be in a lot of safety and then feel bummed that they're not getting the upswing when things are coming in. I know we never know when it's going to be the right time to come in or come out of the market. However, what would you say to someone that has been in safety all the time, and now, like you said, it's down right now in bonds and safety, and they do want to get into the stock market? How do you advise someone to start it? Like if they've never been in the market before, do you have them go in slowly, a little bit, or again, stick with the plan on the goal-based planning?
One, what is your plan? What are your goals? What are the timelines around those goals? And what are the tools and strategies that make sense for each of those goals? If you got time on your side, then and stocks appear cheap historically, then perhaps it does make sense to have that conversation. But that gets to step number 2. If you've never done it before, maybe, I'm just throwing it out there, maybe hire someone to coach you on it, right? Maybe look to work with an advisor or a swing coach to do that, right? If you've never golfed before, most people hire a golf coach, right? They don't just go and hack it away on the golf course. And then number 3, outsource the strategy itself to people that have done it for many, many years. The same way, like if you have an ailment, you don't try to be your own doctor, you hire a doctor, right? You go visit a doctor, or hey, you need a tooth cleaning, go to a dentist. You don't try to do it yourself. It's like the financial industry is very unique in the sense that we as people, most people, outsource most things in our life to professionals. But when it comes to stocks and bonds and asset allocation and planning, we want to do it ourselves. And there's not necessarily anything wrong with that if you have the time. But if you don't have the time, or you don't have experience doing it, and you don't know what you don't know, I think it makes sense to give someone a call, a swing coach, a financial swing coach, a call and say, hey, here's what I'm trying to do. Here's my situation. Do you have any recommendations? Having the humility to sort of make that call.
Yep. And you know what you don't know what you don't know. And I totally agree with
Exactly.
that. And then you also mentioned earlier, I know we got to wrap up right now. We also mentioned earlier about the behavioral. That's why I became a certified money coach on top of an advisor, because I realized that we do have a relationship with money, especially women, and we do have emotions around our finances and our money. So that's where I start with my clients, is that's the foundation, is how do they feel about the money? What do they want the money to do? And go from there on the goals. So the behavioral is huge. It's been so great talking with you, Rob. Thank you so much. Let me ask you, what was the biggest takeaway today from chatting? Is there anything that you want to share, impart, or surprised you?
I think the biggest takeaway, honestly, from today is the importance of sticking to a plan. the importance of not getting caught up in the fear of missing out or the fear that things can go lower, because that's never going to go away, right? Like, we're in a bear market right now. There's no doubt about that. Markets could go lower. We actually think they probably will go lower, but at some point they'll go higher. And you have to manage your emotions by understanding what are your goals and using the appropriate tools for those goals.
I love it. I
And
love it. There's
yeah,
your tips today, folks. Definitely stick with your plan, manage your emotions, find out what your goals are, and rock my finances. I want you to everyone to be able to say, rock my finances. Rob, thank you so much for coming. Everybody visit LifePro Asset Management. Give us a call. We're here to help you out. Don't forget to like, download, subscribe, and tell everyone you know at every party you go to. Definitely tune in to Rock My Finances. Have a great day, y'all.
thanks, Jennifer. Thanks, everyone.
Thanks, Rob.
We appreciate you joining us today, and don't forget to subscribe to the Rock My Finances YouTube channel for more engagement and bonus content. Tell me, what is your money story? Let's find out with Jennifer, 4 p.m. Eastern, 1 p.m. Pacific, every Thursday right here on K4HD Radio and Talk4 TV. It's not about the zeros, it's about the F word, feelings. Feelings Jennifer can't wait to explore with you next week. Until then, let's all say,